Good day, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Monday. It's August 29th. August is almost behind us. It's about 8:34 in the morning. The market's going to open up in about an hour. Actually, the market's going to open up in about 56 minutes to be specific with you, to be very, very exact with you. Sorry, let me just turn my phone off here. Anyhow, as you can see here, the Dow's down about 250 points. The Nasdaq's down about 136 points. It looks like the route that we were on Friday afternoon is continuing, which is kind of puzzling because I don't know what investors thought. The bond market seems to have gotten it right. I mean, if you look at the bond market after Friday's announcement, we went higher actually, which continues to show stability and choppiness in the stock market. Let me just show you this right here. See, choppiness, we're not breaking the lows. We're going back up, which is really good. But the stock market, not so pretty. We really went for a dump. And do you remember somebody by the name of Roger Scott telling you that we're going to go back into this range and we're not going to break out, that we're not done being choppy, and all of these sectors are going to come back into their range and it's too much too fast? Do you guys remember all that? Well, guess what's happening right now? That it's all coming back. Look at technology back into the range. So again, this is not going to be a market that's just going to take off and not come back. Let's talk about what's on the table this week, and then we'll get into the nitty gritty. Okay. So first of all, as far as the agenda, you've got consumer confidence tomorrow. That's going to be a pretty good report. But after last week's hooray, I'm not sure how much of an impact it'll have. But that's coming out tomorrow. That's the first big report of the week. Then Wednesday, you've got the ADP report, which will reflect on the employment situation. That's a private unemployment report. And then you've got a lot of goodies on Thursday. You've got jobless claims, you've got manufacturing, construction spending, productivity and costs, and then Friday, you've got employment situation. Now, remember, last time we had the employment situation, we found out that we had twice as many people applying for jobs as before. Remember, the number was like 500-something thousand, and we were expecting like 200-something thousand. The number was just totally out of whack. We'll see what the expectation is for this week. It takes a long time for this thing to load for some reason. Here we go. Here, prior, 528,000, okay? That's a crazy good number. Consensus 293,000. Look at the range. This tells me they have absolutely zero clue what to expect. But look at how tight the unemployment numbers are. That's what I'm looking at. I'm looking at the unemployment rate. I want the unemployment rate to go to 3.6, to 3.4, to 3.3. I want this number to cool off. If this number cools off and if spending continues, that's a pretty good market. So it'll be very interesting to see what the number is, but I wouldn't really make too much of a heads and tails because they have no idea. When the spread is 200 versus almost 400 and you're right in between, they honestly just have no clue. But that'll be a very interesting number to look at. Earnings are winding down and volatility, as I warned you, is heating up. Do you guys remember I made a big deal about everything coming back into that hump, that this hump was going to that we're not going to get out of that area? Well, guess what? The only sectors that got out of that hump was consumer staples and healthcare, and they're back down there right now. What's interesting is if you look at the energy market, the energy did not sell off on Friday, and it looks to be holding on much better than anything else. But like if you look at communication services, we're almost back down to the lows. If you look at technology, see that? We're back into that area, that choppiness area. Every sector is back, and even utilities are cooling off. Not that much, but they are cooling off. But I think this is a little too much too fast, and I think we're going to get a bounce off of this. But overall, I do still like the energy sector quite a bit. In terms of strength, it's all starting to make a lot more sense now. Utilities, energies. You see consumer discretionary, you look at technology. I am telling you right now that these are going to become best friends again as the market cools off. But it says that we may not be done yet. Notice consumer staples is starting to come up. Oh, yeah. And same thing here. Energies, consumer discretionary in between. No. This is all wrong. You can't have consumer discretionary here and communication services here and technology here. That's one hell of a fragmented market. How do we get rid of a fragmented market? By cooling off. Now, another thing I wanted to show you, and we've been talking quite a lot about this, momentum levels. Oh yeah, it's like that. Do you guys remember I was showing you how unstable the stocks above the 200-day moving average are, and showing how the stocks above the 50-day moving average are going to cool off? I was showing you this when it was at 97%. It's now at 59%. I was showing you information technology at 93%. You see where it is? And if you look at these now, they look like they're cooling off. Look at that. And again, these momentum levels, folks, they're going to come down. See that? Look at that. They're going to come all the way down. But meanwhile, look at consumer discretionary on the 200-day. It's already down there. So all of this stuff right here is going to end up looking like this, except for energy, which has a really good utilities. And let's see here, consumer staples still 60%, 67, 60. It's not that far off. Now, here's the interesting thing. Everything I'm showing you right now, I talked about for the last 3 weeks, and I told you exactly this was going to happen, and it's happening right now. I told you that the short term is too overbought compared to the long term. I told you that the market momentum levels are not strong on the 200-day line, and how the 50-day is getting way out of whack, and now it's coming back, and it's time to pay the piper. All right, let's look at global economy. Now, I'm going to tell you what's really surprising. The Fed said they're going to keep doing what they were going to do, and the market got really disappointed. I'm curious, did anybody really think the Fed was going to start lowering rates? Did anybody really think the worst was already way behind us and we're going to start getting the little stocks to come back up? All I said was that we're in the middle of what's bad and that we may stay choppy for quite some time. We may not go lower. But I never said anything about making new highs or any of that stuff. People really took this data and went for it. They really thought the bull markets were coming back. We're not there. Not so fast, folks. We got a lot more stuff to get through before we get there. U.S. markets pointed towards more losses hours before the opening bell today. They're down right now, as you could see right here, where the futures markets are as we speak. As you can see, nothing's looking all that pretty. So we'll see how it all happens. But I'm being a bottom picker for certain stocks right now. The message from the Federal Reserve Powell in the speech Friday, though some hoped it would be less emphatic. I thought he was doing exactly what he said he was going to do. I don't understand what the big surprise is all about. Also waiting on regional sentiments, Chinese economic data over the weekend, which seems to indicate a strong recovery will take time. It's not going to happen overnight, folks, and that's kind of what I'm getting at. Chinese January to July industrial profits sank 1.1% from a year ago. COVID restrictions. Powell said the Fed will likely keep interest rates high enough to slow the economy for some time in order to beat back the high inflation sweeping the country. Right. The Fed has already hiked its key overnight interest rate 4 times this year in hopes of slowing the worst inflation in almost 5 decades. Higher rates help corral inflation, but they also hurt businesses. Powell acknowledged the increase will hurt U.S. households and businesses, perhaps an unspoken nod to the potential for a recession. But he also said the pain would be far greater if inflation was allowed to fester, and that we must keep the job until the job is done. I agree with him 100%. I just wish he started going down this road a year earlier. But honestly, what were investors expecting? I still don't know. So in terms of the bond market is down this morning. It's at 112. Here, let me just point. As long as we stay within this choppy factor, I'm not expecting too much of a bleed. Once the bond market starts breaking lower, that's going to put too much pressure on the stock market. As far as sectors, I think we're going to cool off. I think we may have another down day, but I think we're going to have a reversal because Tuesday is usually a reversal day. So look for some more downside today, but look for a bounce. I think this is too much too fast, and I'm actually looking at where's my utilities? I'm actually looking at energies, and I'm actually looking at utilities, and I'm kind of liking them. So I wouldn't be surprised if we had a bounce back over the next 24 hours. And again, you've got consumer confidence tomorrow. That's going to reflect on the stock market. Now, as far as sectors, as far as individual sectors are concerned, let me just go to the main page here. I want you to see exactly what's happening right now. This is Friday's data. Energy, utilities, consumer staples. Over the last month, energy, consumer discretionary, utilities. No. This has no place here. This needs to fall down. Last 5 days, energy, materials, consumer staple. Look at consumer discretionary. This is how it should look. Consumer discretionary, communication, infotech. So I think this kind of a 5-day route, what you're seeing, is going to continue. Take a look at this, because if you look at bar chart and look at their 5 days, I think you're going to continue to see this pattern until we bounce over the next few sessions. Meanwhile, here is my suggestion for you guys right now. The strongest sector right now is energy and utilities, and those are the sectors that you want to be buying right now. You don't want to be in speculative stocks, because, let me show you, look at what's leading. Oxy, Albemarle, Devon Energy, Mosaic. Notice that's coming back, and look at what's lagging behind. Newmont, Intel, Mohawk, Dish. Remember Dish? Expedia. Don't think those stocks are going to do all that great in the near term. So you got to be very, very careful right now. Now, many of you know that I love working with other traders. I really do. It's the best way I know how to improve my own trading. And that's where Jack Carter comes in. Not only does his experience blow most investors away. He's been doing this for like almost longer than me, I think close to 35 years. But he truly cares about his readers, and that's something I really respect. And that's why about 3 months ago, we set out to build a new system. I think you're really going to like what we've created. I really love it. Now, if you like building systems, using systems, understanding how systems work, you've come to the right place. Click the link below, get all the details. Jack Carter and me, we're going to be doing and showing you guys something really, really cool, and I don't want you guys to miss out. Follow the link below, check it out right now, and comments, feedback. I haven't heard from you in a while. I'm getting lonely out here. Bye, guys. Have a great, great day.